If you're thinking about using an FHA loan to buy a home this year, I need you to hear something before you submit an offer. One of the biggest mistakes I see buyers make is assuming FHA is automatically the best loan for first-time home buyers. I've heard people say FHA is the easiest loan. FHA is the cheapest loan. FHA is what everyone should use if they don't have 20% down. And honestly, that is simply not true. Now, before anyone misunderstands me, I want to be very clear. I am not against FHA loans. As both a realtor and loan officer, I've helped many buyers purchase homes through FHA financing. In fact, FHA has helped millions of Americans become homeowners, including many first-time home buyers. FHA absolutely has a place. But what concerns me is when buyers choose FHA without fully understanding how it works, what it costs, and whether there may be a better option available. Because in some situations, FHA can be an incredible tool. And in other situations, it can cost you thousands of dollars, more than necessary. So in this video, I want to walk you through the biggest reasons you may want to think twice before automatically choosing an FHA loan in 2026. And just as importantly, I will explain when FHA can be a fantastic option and why it continues to help so many people become homeowners. Now let's start with one of the biggest misconceptions I hear. Many people think FHA equals first-time home buyer loan. Because of that, buyers often begin the process already convinced that FHA is the only financing option they should consider. But FHA is simply one loan program. It is not always the cheapest, it's not always the easiest, and it definitely is not always the best fit. I've worked with buyers who came into the conversation absolutely convinced that they needed an FHA financing, and then after reviewing everything, we discovered they qualified for conventional financing. Sometimes the conventional option actually has lower overall costs. Other times there were down payment assistance programs available that they didn't even know existed. The lesson here is simple. Do not fall in love with a loan program before you've looked at all your options. The goal is not just getting approved, the goal is finding the financing option that puts you in the strongest financial position both today and years to come. Now let's talk about what I believe is the biggest downside of FHA financing: mortgage insurance. And this is where many buyers get surprised. Anytime you put less than 20% down, there's usually some type of mortgage insurance involved. That's not unique to FHA, but FHA handles mortgage insurance differently than many other loan programs. With FHA, you will typically pay an upfront mortgage insurance premium in addition to monthly mortgage insurance. Right now, that upfront mortgage insurance premium is 1.75% of the loan amount. Let's use a simple example. Imagine you're purchasing a $700,000 home with the minimum FHA down payment. Your loan amount might be around $675,000. Before you've even made your first payment, FHA is adding another 1.75% to that balance. That's over $11,000 added to your mortgage. Many buyers don't even realize it's happening because it's financed into the loan, but it's there. You start with a larger loan balance, you start with less equity, and your overall borrowing costs increase. Now, if that wasn't enough, here's the part that surprises many buyers even more. With the minimum FHA down payment, your monthly mortgage insurance typically remains for the life of the loan. Think about that for a second. 5 years from now, 10 years from now, 20 years from now, you will still be paying mortgage insurance unless you refinance into another loan program. Compare that to many conventional loans where mortgage insurance can eventually be removed once enough equity is built. That is a significant difference. And in a market where affordability is already stretched for many buyers, every dollar matters. And this is why I always tell buyers not to focus solely on the interest rate. The interest rate is important, but it's only one piece of the puzzle. You need to evaluate the total monthly payment, the mortgage insurance, the cash needed to close, the fees, and the long-term cost of the loan. I've seen situations where FHA had a lower interest rate than conventional financing, but still produced a higher monthly payment because of mortgage insurance. And that's why the better questions are, what's my monthly payment? How much money do I need at closing? What's my mortgage insurance cost? How much will this loan cost me over time? And how long do I realistically expect to keep this loan? Those answers matter far more than simply comparing interest rates. Now, let's shift gears and talk about something that often catches buyers by surprise after they've already found a home. FHA appraisals. A conventional appraiser is primarily focused on determining value. An FHA appraiser is determining value too, but they're also making sure the property meets FHA's minimum property standards. That means they are paying attention to things like peeling paint, exposed wiring, broken windows, roof concerns, safety hazards, foundations issues, and other repair items. If you're buying a newer home that's been well maintained, this may never become an issue. But if you're buying an older property, a fixer-upper, or a home that needs work, FHA requirements can sometimes create additional challenges, and sellers know this. In competitive situations, some sellers may prefer a conventional offer because they believe there will be fewer repair requirements. Again, that doesn't make FHA bad. It just means buyers should understand how FHA works before making an offer. Another challenge involves condos. Many first-time buyers begin their search with condos because they can often be more affordable than single-family homes. The problem is not every condo complex is FHA approved. I've seen buyers find the perfect condo only to discover the community doesn't qualify for FHA financing. Sometimes there are too many rentals. Sometimes there are HOA issues. Sometimes there's a pending litigation. Sometimes the project simply doesn't meet FHA guidelines. The point is, FHA financing can involve additional layers buyers do not discover until they have already deep into the process. Now, here's where I want to talk about one of FHA's biggest strengths. FHA is incredibly flexible. In many cases, FHA allows higher debt-to-income ratios than conventional financing, and that flexibility is what really allows many buyers to become homeowners. I've worked with buyers who simply could not qualify for a conventional loan, but were able to purchase a home using FHA financing. That is powerful, and here is where I encourage buyers to slow down and think carefully. Just because you qualify for a payment does not mean it's the right payment. I've seen buyers push themselves all the way to FHA maximum guidelines because they're excited to become homeowners. I completely understand the excitement, but homeownership is about more than qualifying. You have maintenance, repairs, property taxes, insurance, HOA dues, and life happens. A home should bring stability and opportunity, not constant financial pressure. And that brings me to what I think is the most important thing in this entire video. For many buyers, FHA is not the destination, it's the bridge. It's the tool that helps them get into the market sooner. I've worked with many buyers who started with FHA financing, built equity, improved their credit, and later refinanced into a conventional loan. For those buyers, FHA worked exactly as intended. It helped them become homeowners sooner and start building wealth. That's why FHA can be such a powerful tool. The mistake happens when buyers assume FHA is automatically the final answer instead of one possible step in a larger plan. So when does FHA make sense? In my opinion, FHA often makes sense when you have limited money for a down payment, your credit score is not ideal, your debt to income ratio is higher, or FHA allows you to buy now rather than waiting years to become a homeowner. Those are situations where FHA can be incredibly valuable. The biggest mistake I see buyers make is it becoming emotionally attached to a loan program before comparing all of their options. Don't decide you only want FHA. Don't decide FHA is bad. And don't assume FHA is automatically the best. Instead, compare everything. Look at FHA, look at conventional, look at VA if you are eligible, look at USDA if it's available. Then compare the payment, the mortgage insurance, the cash to close, the flexibility, and the long-term costs. Because what's perfect for one buyer can be completely wrong for another. At the end of the day, FHA loans are neither good nor bad. They're simply a financial tool. The key is understanding the trade-offs before you sign the paperwork. If you understand the costs, compare your options, and build a long-term strategy, FHA can be an incredible path to homeownership. And if you have questions about FHA financing, leave them in the comments below. I read them personally, and many of my future videos come directly from questions buyers ask. And if you are looking to potentially buy in the near future, I hope you click that link below. If you're not in Colorado, I would love to connect you with a real estate agent in your area and go over all of your options on the lending side.